Hello and welcome to Asking for a Trend. I'm Allie Canal. For the next half hour, we're breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here are some of the trends we'll be diving into. Stocks slipped Monday as investors digest reports of a China tariff extension with the U.S. and as investors await CPI data on Tuesday. At the end of the trading session, all major indexes ended the day lower. Plus, the streaming wars, movies, and sports. Investors eye all opportunities for risks when it comes to media. We're talking with an expert on some of the best trends and plays. And how solid is gold? Right now, investors seem to see it as a super solid play. We're exploring the commodity's record moves with an expert that's coming up. Well, as the global entertainment and media industry marches towards a projected $3.5 trillion in annual revenue by 2029, new value streams are emerging. Let's welcome in Bart Spiegel, Global Entertainment and Media Deals Partner at PwC. So Bart, we have these conversations, you and I, frequently about the state of media and entertainment. You guys just published your latest report on the outlook here.
That's right.
What were the big takeaways from you, especially when we look at the cable landscape, the sports landscape, and really what's driving a lot of these moves?
Yeah, well, I think when you look at linear cable, the linear cable ecosystem is still going to be around, right? It's not the sexy, high growth, what you expected to see, but we know that based on what our data is telling us, it's actually going to continue to decline. That's what we're forecasting. But it's still turning off a significant amount of cash flows. And what does that mean? Well, it means that there are still people interested in it. Radio still throws off a good amount of cash flows, and you have a significant infrastructure attached to that linear ecosystem. So we expect there to still be continued engagement, but again, it is slipping, it is declining, and so more people are pivoting to streaming, and so we're obviously expecting streaming to grow significantly in the future, especially through 2029.
Is that why these legacy companies can't seem to break up with cable? And I know you can't talk specific companies, but we've had multiple reports out that NBC is toying with an idea of releasing a cable channel totally dedicated to sports. And it just makes me scratch my head a little bit because we've seen the linear television decline, those revenues decline, but there just seems to be, you can't walk away.
I go back to that infrastructure that's there. And you know that you have an audience that's still subscribing to linear, and they're still going to be there. They're still going to be generating revenues. And as a result of that, think about it, if you're churning off those kind of cash flows, it gives you a lot of opportunity for financial engineering, and maybe you can use those assets for debt. Maybe they could act as collateral. So there's still opportunities for companies out there that have that portfolio and those assets to still be accretive. Again, it's not going to be the high growth engine that people were looking for, but at the same time, it is going to be something that gives you optionality in the market.
And a big part of that is sports, right? And sports is on cable, it's on streaming, it seems to be everywhere, and that's driving a lot of eyeballs. Even today, we saw a landmark deal between Paramount and UFC. So when you look at the sports rights battles, how is that impacting streaming platforms? How is that impacting legacy media in a way that in the next 5 years, it might be completely different than what we have today?
Well, what you have is the ultimate in appointment viewing, right? Because so much of the infrastructure now and the ecosystem, you can just tune in and watch whatever you want at any time. But sports is still the ultimate in appointment viewing. So we expect that to continue. And as these rights fees come up, you have more people, more platforms bidding for these rights. And we expect with more competition, those prices are going to go up. And when you add into it the fact that online gambling is getting legalized in many different states, that only adds to the user engagement because more people are tuning in, more people are showing an interest in sports, and even different sports than the core that many people have traditionally focused on. So I think online gambling has opened up people's mind to okay, what else is out there that I could be entertained with?
And how is this changing the power that these sports leagues hold? About a year ago, after Netflix announced they were going to be rolling out NFL games on Christmas Day, I spoke with the NFL, and they told me they don't want to just be on cable or just on streaming. They want to be everywhere. And it feels like that power then is firmly with these leagues.
Yeah, the leagues have a lot of power at this time. They're content creators, right? And so anyone that owns content, owns IP, we always say content is king, right? And it's no different with these leagues that are creating this content and putting out there and striking really creative deals as well to ensure that their property, their IP, continues to be popular in perpetuity.
That's a great way to think about it, right? That is their IP. If we look beyond sports, what's the next content category or experience that you think will create that sticky moment for consumers?
So it's interesting. 2026 should be a really big year for video games. We really believe that. You've got the esports Olympics in 2026. You have a really prominent title expected to be released in 2026. And video games just helps the whole sector in general, right? They come up with original IP that is then marketed for TV and movies that you see being played out. You also see video games utilizing a lot of their technology and infrastructure to help in film, special effects, TV, et cetera. So we see a really big year for video games in 2026, and our forecasts show that. We also see, don't sleep on live experiences either, because I think live experiences are extremely important. You'd have, that's where a lot of money that's going for the 18 to 25 really sought after demographic. That's where they're spending their time and energy because it plays into the whole social media platform as well. Because now they can go do these live experiences and post it to social media for their friends, their followers, et cetera. And that's really attractive to them and really compelling to them. So I think live experiences are going to continue to be extremely popular. We have it, the spend on live experiences still exceeds the spend on digital experiences, and we expect it to continue.
And to that point, Live Nation earnings, they've been crushing, and a big part of that is people are going and traveling to see a lot of concerts. So that's a great point. And when we look ahead to M&A, it was a bit stagnant in the entertainment space. We saw a bit of activity. We finally got that Paramount Skydance deal going through. What are you watching for when it comes to upcoming deals? Do you expect the end of this year and into 2026 to be a lot more active than what we've seen?
I definitely do. There have been a lot of announced spins, separations, things like that. And I think when you look at the OTT streaming environment, it's really kind of happened in a bunch of different chapters, with the first chapter really being focused on, okay, let's just throw money at content, throw money to get people and subscribers onto the platform. Then the second chapter was really, let's take a step back, focus on ROI, focus on really making sure that we've got a profitable business. And now I think you're going to look at chapter 3, which is what you're seeing happening right now, real time, some of the things that you mentioned, which is, okay, what are some creative partnerships, joint ventures, M&A, where there's going to be some level of consolidation in the ecosystem, because we've done studies ourselves where the average consumer doesn't want to pay for 10 subscription services. They want 3 to 5 subscription services. And so, this allows them to consolidate, take advantage of economies of scale, and that's what I think we're going to see in the next year. But then going out from there, I think then it's all about what other things can you bring to your platform. Video games, social media, user-generated content. And that, again, will just continue to apply that stickiness factor where people are willing to pay more and limit the churn that you have on your platform.
And finally, let's talk about artificial intelligence, because we've heard from many analysts that we're still early days.
Yes.
How are these entertainment giants implementing AI, and how will that help their businesses and help improve some of those things that you were just talking about when it comes to stickiness?
Yeah, well, so AI's been around in the industry, I feel like, for quite some time, right? Even some of the search and suggestions, like that type of technology, all kind of resonated and gave its birth in AI. But when you think about going forward, you hear a lot of talk around cost cuttings, the advantages it'll have with AI in terms of, hey, listen, we can speed up our content delivery, we can speed up the process with which we create our gaming, our coding, et cetera. But what I think the differentiator is going to be is who can use AI to grow the top line, right? What are the new business models? What are the new things we can do with AI that are going to be really compelling for people and drive the top line and not just focus on just bottom line cost cutting initiatives? It's really about what's out there and what's in the future and how can I capitalize on that?
Yeah, definitely an industry that's poised for potentially even more disruption here. Bart
Absolutely.
Spiegel, thank you so much for joining us. U.S. stocks closing lower to start the week. Let's bring in our data and markets editor, Jared Blickery. So, Jared, a bit of a blah day for markets, I would say.
Well, I was excited on the open because we got a pop in tech. We got a record high in the NASDAQ, not only the NASDAQ composite, but the NASDAQ 100. And you can see that was shortly after the open. It didn't take much, but you know what? We slid into the close. And so it's kind of a meh close to a meh day. And this is what we have in bull markets. Not every day is exciting in the indices. Sometimes you got to peel back the hood and check out what's going on underneath. And I'm going to show you the semiconductors. Semiconductors also kind of sputtered out towards the end. NVIDIA was looking somewhat solid all day, but then kind of slipped into the close. We had some favorable news about chip stocks that we were talking about all day. Intel and Micron were kind of the stars of this. But then you take a look at software and you got some bigger losses here. And that's kind of what I was looking at. And this reminded me of some of the boards we had last week. Not all tech is the same. Semiconductors more cyclical, but what we've seen is software, the recurring software names just haven't performed as well recently. Oracle is a bit of an exception here along with Take-Two. Always exceptions, but the norm is, you get in a bull market, you have rotation, and that is the lifeblood of the markets. And so today we're just kind of rotating a little bit.
Right, and it'll be interesting what happens tomorrow, too, because we'll have the CPI. Consumer Price Index, CPI, that's fueling a lot of the debate when it comes to what the Fed is going to do in September.
Exactly, and that brings me to point 2, which is, are we going to get that Federal Reserve cut? And it's interesting, not only are we thinking about September, we're thinking about all the way next May when we get a new Fed chair, assuming it happens May and not sooner, but the B of A Global Fund Manager Survey, which we've been covering throughout the day here, they poll all these big investors, and this is what they're expecting for the next Fed chair. They're going to are we going to see quantitative easing again or yield curve control? Both of those are extraordinary measures, and yield curve control is about kind of containing those long-term interest rates that we have. They've been surging at various times. We've seen the 30-year above 5%, and that's been a concern for markets. So 54% are saying, yes, we're going to see extraordinary measures versus 36% no. That is becoming a consensus opinion. I also want to add to this. We did have a Stocks in Translation sit down today with Colin Martin over at Schwab, and we talked about all of this stuff in addition to these Fed rate cuts. Here's what he had to say.
Right now, let's say you can get a T-bill, 3-month T-bill, we'll say at 4.25%, close to the Fed funds rate. In a few months, when that comes due, maybe it's 4% or maybe it's less. So reinvestment risk in a declining short-term interest rate environment means that if you're holding short-term investments, you might see your income decline over time.
If you've ever wondered what the yield curve is, what it means, what quantitative easing is, what yield curve control means, we break it all down. That episode is dropping tomorrow, August 12th in the morning. So
I love it, Jared. Give me all the shameless plugs. But it has been interesting to look at the long-term yields, right? Because largely they moved sideways since the start of the year. Yes, we've had pops here and there, but now we seem to be pretty chill. But one thing that hasn't moved sideways is crypto, right? I mean, continuing to surge.
That brings us to our next point. Cryptocurrency got a little bit of a jump today. It also kind of fizzled, but it retained more of its territory. And let's go to our crypto board here, and we'll take a look at Bitcoin, kind of the kahuna here, but Ethereum really caught my interest. So here we go. We got this pop around midnight, 1 a.m., and this just kind of fizzled out here, but check out the year to date. There is no denying that this is a nice bull market here, and we're just kind of trying to struggling to get beyond this resistance area, about 120,000. It's been higher, but this is kind of par for the course. Crypto will go sideways for a while, a little bit down, scare people, shake people out, and then it pops higher. So are we seeing the next beginning of that? In Bitcoin, I don't know. But check out Ethereum, because Ethereum has finally exploded to the upside above 4,000. And that is not a record high, but 4,500 is a record high. Now that this resistance has been cleared, I think it's kind of easy sailing to get to 4,500. That's where the rubber meets the road. We've also seen pickups in all these other currencies, the altcoins, for instance, and we'll just have to see. I like to see breadth on these moves. Not a lot of breadth right now, but we have seen it within the last month. So we'll have to see if that continues.
Great point here. I mean, the focus is usually on Bitcoin, the star of the show, but Ethereum moving
with the stable coins, you got to look at Ether now.
That's true. Absolutely, Jared. Well, thank you so much. Around half of investors have exposure to gold, with 4.1% as the average allocation, according to Bank of America's August Global Fund Manager Survey. Gold tends to creep into headlines when there's more economic uncertainty, prompting investors to seek safety in safe haven assets. Our next guest sees an upside scenario, but isn't necessarily bullish long term. Here with more is Carley Garner, DeCarley Trading Commodity broker and analyst. So Carley, let's dig into your outlook on gold. Where do you see prices heading by the end of the year? And do you expect any choppiness before we get there?
So I actually have an unpopular opinion. I think the gold rally is in its last leg, or you could say the ninth inning of the move. We've had an incredible rally in the last 3 years. Started around 1,600 in gold, and obviously now we're trading into the $3,400, $3,500 range. But 3 years ago, if you would have mentioned gold to people, they would have thought of the exact opposite of what they're thinking of now. It was the dog of a portfolio. It hadn't done anything in over a decade. It doesn't pay interest or dividends, so there was no reason to hold it then, or so people thought. That was the consensus thought. And now we're in the opposite boat where everybody wants to own gold. Just as those people were probably wrong, well, they were wrong 3 years ago, I think they're probably wrong now. I think gold is the type of market that you want to be bullish when nobody else is bullish. When everybody is bullish is probably not the best time to be a buyer, unless you're just strictly seeking diversification and your time horizon is decades, not months or years.
Interesting. Now, and it is also interesting to see how much gold has been in the headlines recently. President Trump saying that gold will not be subject to tariffs. How do you avoid getting caught up in these headline-driven moves here?
Well, I'll tell you, it's difficult. We've first, a few weeks ago it was copper, now it's gold. But what we've learned from these lessons is a good strategy for anyone that's thinking of participating in commodities is the sidelines as a position. It's a lot easier to react after there's some sort of surprise tariff announcement than there is to be in the market while the news is coming out. And we've seen in copper and gold, the tariff news generally is, well, in these cases anyway, has triggered an overreaction, and then the market gives it back. Today's tariff is tomorrow's walk back of that tariff or clarification, and the market corrects. And so just like we saw in copper and gold, I think most markets going forward, if you get some sort of overreaction on tariff news, it's probably a good idea to fade it if you're out, and then kind of anticipate a repricing afterwards. Because again, these moves are temporary. The market generally overreacts first and asks questions later. So it's better to. Unfortunately, sometimes we're in the market when we in the wrong place at the wrong time. So that's going to happen, obviously, but it's not going to be boring. That's for sure. We got to stay on our toes.
Yeah, certainly hasn't been boring this year at all. But you mentioned in your notes to us that gold and the U.S. dollar, they've moved in opposite directions about 93% of the time over the last 9 months. How should investors factor the dollar's path into their gold strategies moving forward?
Right. So there's a lot of people buying gold here because they're of the opinion that they can't trust the U.S. dollar, whether it's political or because of the U.S. debt that's piling up or whatever the reason is. They're not fans of the U.S. dollar. But the reality is the dollar has probably seen its low and it probably rallies. And if that occurs the way that I think it might, all else being equal, if we return in the dollar index to the 108, 110 area, which is where we started the year, and believe it or not, I think that's a real possibility. I'll just real briefly, because if you look at math, interest rates are higher in the U.S. The economy here is a little better than most other developed countries, so there's no mathematical reason to not be in the dollar for most investors. That said, if the dollar returns to where it was in the beginning of the year, that alone will push gold under 3,000. So all else being equal, higher dollar is going to equate to much lower gold.
And for those long-term gold holders, you brought up Costco as a convenient way to buy physical gold, but there are challenges selling it back at a fair price. So what advice do you have for those long-term investors when it comes to liquidity and exit strategies and really how to play the gold market?
Right. So Costco is an amazing place to buy gold, but they're not a dealer. They don't take it back. They don't take returns, and they don't buy it back from you. So you're going to have to find somewhere else to sell it. And that's the hard part. Most cities have dealers. They're usually not in the nicest areas. So it's a little bit, it's not necessarily comfortable to be walking into a store with several $1,000s worth of gold bars or coins or whatever it is in your pocket. So selling them is not the experience that most people expect. And further, when you go to sell it, you're probably going to receive 5 to 10% less than the price that you see on TV, because there's a little bit of a haircut there. dealers have a bid-ask spread, and they, of course, they're always going to sell you the low price and buy at the higher, or make you buy at the high price. Also, there are some mail-in type of programs where you can mail the bullion, but it's a little bit scary to also be mailing thousands of dollars worth of gold back and forth, and you have to insure it, and you have to get it assayed, which is basically like certified to make sure it's a proper quality. Mm-hmm. And so, I mean, it's just so much more complicated than most people think. So it's a kind of asset where it's easy to buy, but it's not very easy to actually sell.
And we're seeing gold prices trade to the downside today, just under $3,400 an ounce. Carly, thank you so much.
Thank you.
Let's take a look at what's trending after hours. Big Bear AI is plummeting after missing on revenue in the second quarter. Revenue clocking in at $32.5 million versus the street's estimate for $40.6 million. Big Bear projecting full year 2025 revenue between $125 million and $140 million. The company touting its balance sheet, saying it's enabled the company to make investments. The CEO also saying in the release that while they're optimistic with investments and growth opportunities, they've seen disruptions in federal contracts this quarter. The firm has adjusted its full year guidance to reflect these disruptions. And nuclear energy firm Oklo reporting a bigger loss per share than expected, 18 cents. The street was looking for a loss per share of 11 cents. The company is seeing a beat in research and development operating expenses, clocking in at $11.5 million versus just over $9.3 million estimated. And Archer Aviation falling, reporting a 45% jump in operating expenses year over year, but it did see a bigger adjusted EBITDA loss than expected. For the third quarter, the company expects adjusted EBITDA to be a loss of $110 million to $130 million. The company highlighting a ramp up of aircraft manufacturing in the second quarter across California and Georgia facilities, with 6 Midnight aircrafts in production. That includes 3 in final assembly. Well, that's a wrap on today's Asking for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market moving stories affecting your wallet. Have a great night.